Hey, everybody, Kevin here again with another episode of the Real Estate Without Renters podcast. Appreciate you all listening to the show and definitely referring it to a friend. Real estate investment clubs, meetup groups, wherever you're talking with other investors. Sure love to have you share that with us and continue to grow and bring you more and more episodes, including special series. And that's what we're going to be doing on today's episode, because we are in some uncertain times. But I'll tell you what, uncertainty provides opportunity for those who are aware of it. And I've asked my friend Dave Frenike to come on, and I'll introduce you to Dave once again in just a minute here. But I wanted him to come on because we both have experience through various turbulences in marketplaces. And if you're a full-time investor and you get caught by some of these, which all investors inevitably do, you take some hits. And you learn from those hits, and you start to say, "Not this time around. I've learned more. I'm better prepared for this." And that's why we wanted to put together this special series. So I'll be doing other podcasts, but this series is going to continue on a theme of how do we deal with inflation, possible recession, possible crashes, all these other things that are in the news that you're likely very aware of. We want to take those and put it into our world and how it may apply to us in both real estate and real estate notes. And that's the purpose of this series. We're going to have a number of these. The number is undetermined because the economy is going to be changing. So we'll do these as long as the information is current, update, and worthy of putting out there for you. But we're also going to bring in some special guests as well that will give us their opinions of that. And it'll all be real estate and real estate related. And if you're listening to this on the podcast, something that I haven't done in the past, but I'm going to do in this series is upload full video of this to YouTube. So I have a YouTube channel on there. You can check that out. You can search my name, Kevin Shortle. It'll come right up. And please subscribe to the YouTube channel. That way you won't miss anything. In addition to this special series, you'll also have my tip of the day, which I put out probably 4 or 5 times per week for you, all geared around real estate and real estate notes. The reason I point out the YouTube channel also, by the way, is because we are going to have some graphics. We're going to have some PowerPoints and things like that. So Dave and I, to the best of our abilities, because we know we have a listening audience as well that's not going to be able to visually see these graphs, we're going to describe those as best we can for those just listening on the podcast. But certainly if you want to see those graphics and charts and everything, just take a quick click over to YouTube, subscribe to that channel, and we certainly do appreciate that. And as always, if you enjoy the show, please go ahead and give us a nice 5-star rating there. That, believe it or not, that does help. It gets us more exposure and also gets us sponsors for the show and everything else. And I certainly would appreciate that, as would Dave. So Dave, how are you?
Doing well, my friend. How are you?
I'm doing just great. Always good to see you. Always good. We always have great conversations, Dave and I. We got together in person in Arizona a couple months back and had lunch and all that. So we have a lot of congruency in our thinking, and I think he brings a lot to offer. But Dave, some of my listeners may not know, even though you've been on the podcast, I think twice now. Some of them. What's that?
We've been on several back and forth over the last couple of years.
Yeah. So there may still be some people that don't have your background and such. So why don't you go ahead and help us out with that a little bit?
I've been in real estate for a long time, since the late 70s, whether it be building and developing, whether it be REO guy, whatever the case might be, and then notes since 2012. So I kind of evolved and followed the trends, and the whole idea just to take advantage of whatever's there and make money. And then learning from your mistakes, hopefully, so that you don't get crucified in the future. And I have been crucified in the past in a big way. So right now, as Kevin and I were saying, and as the slide says there, you have to understand what you're doing to mitigate your risk. There's always risk, but you have to mitigate that. And another way of saying it is when to buy, when to sell, how to buy, and how to sell. So Kevin and I are going to be looking at how you, our viewer, can benefit from our past and what we observe, and take advantage of what we talk about here and flourish, not just sit there and like, oh my gosh, what am I going to do? I think that's a pretty spot on statement, Kevin.
Yeah, absolutely. And, for those who are listening on the slide right now, we're looking at says risk comes from not knowing what you are doing. And that's really part of the definition of ignorance. And I don't mean ignorance is not calling somebody stupid. If you're ignorant, you're just not aware of what you're not aware of. And that's why I've carried that theme when I've been teaching this for over 20 some odd years now. I always look at everything from a risk of view first. What's my overall risk? Because my reward can change. I can negotiate a better reward. I can apply exit strategies as a better reward down the road. But if my risk isn't within my tolerance, it's not worth it. So I believe in teaching the note business and the real estate business in its totality, even though you may not apply everything. What I mean by that is there's typically in our note industry, we divide things into performing notes and non-performing notes. But the reality is if you just learn about non-performing notes and don't know anything about performing notes, eventually that's going to catch up to you. You're taking on more risk. If you just know performing notes and don't understand non-performing notes, eventually that's going to catch up with you. And again, you're adding more risk. So the more that we can do financially, understanding the number part of this to reduce our risk is great. The other part comes from our personal growth in the industry, which can also decrease our risk because we know when things go bad, how do we noodle our way through that? And over the years, Dave, by the way, has been very gracious about sharing case studies. You know, I like to teach from case studies, and he's supplied me a number over the years. And boy, some of these, you know, I think I've interviewed you on some of these. It's just so many twists and turns, but ultimately you came out good on everything because of your knowledge base in the industry. So I think that quote that you have on your slide there is apropos. Risk comes from not knowing what you are doing. Add in the uncertainty, and boy, that throws a whole different variable on there, right?
Yeah, and I'd like to share something. This applies directly to you, Kevin, and one of your students without mentioning a name. He had just bought a note from me. It was a seller finance note, true seller finance note. And it turns out that the payment history was not accurate. It's like, okay, that's normal. Mm-hmm. And the gentleman kept talking and talking. This is just yesterday, as a matter of fact.
Yeah, yeah.
And the net, as I said, well, then, were you hurt or did you make money on this? He says, oh, no, I made money. And he went through it. And I know that you and he had gone through it and you both missed something. Okay, no big deal. But he bought it right to begin with. So he couldn't really get hurt. I think he picked up an extra, 20 payments?
10. Yeah, 10 payments.
So, yeah. I mean, at $600 a month, that's not bad.
That's significant. Yeah, that's significant.
So, I mean, and he had one heck of a time boarding it. But again, he navigated through the weeds and through the potholes, and he had you helping him.
Yeah.
And then he'd call me occasionally along the way. Yes, I brokered it to him, but he won. And I think that's cool.
Yeah. Yeah, absolutely. And you know, you go through due diligence process on this. A big part of that is to reduce your risk, but sometimes there are some little things, and this was a little subtlety without going into all the details of it that you just kind of missed. But when we went back and reworked it, it's like, there it is, you know, so yeah, worked out pretty well. All right. So our first topic on this series is going to be something that's very obvious that we are currently in right now, and it's an inflationary period. So our dollars are buying fewer assets. And of course, everybody is looking at gas prices, food prices. You know, again, you can combine shortages and everything else, but the bottom line is that overspending over a number of years here and accelerated more recently, it's making our dollars worth less. And it also means that it's going to be reflected in our investments. If you have your money, for example, in a savings account right now, you're losing about 8% per year on your money. It's going the wrong. Is it higher now, Dave? Oh, Dave's been doing a lot of research, by the way, on this. So he's going to be on top of a lot of the stats.
If you go to shadow stats, Kevin, inflation is really 30%.
Oh boy,
that's a reality.
Yeah, there's 4 different ways that they calculate it, and then there's one that's the established, but it's certainly dumbing down.
Yeah, no, but shadow stats is 30%. That's the reality. So therefore, how do you take advantage of that inflation factor? Mm-hmm. How do you put that into the equation on your buy pattern, your buy box? That's a better word.
Right. Yeah, because it affects all of us across the board. So whether you're investing in notes, real estate, or stocks and bonds and everything else, not only are we fighting the inflation, but the other risk. I mean, crypto, for example, right now has just tanked. The stock market's been tanking. So you add that tanking in with inflation, and boy, it's going to be tough for some people to recover from that. So it's certainly something we have to look at. And yeah, how they calculate it. That's crazy. That could be real inflation, not just what they tell us is on there. It's pretty frightening. But again, how do we navigate? So part of this is we want to keep what we have. We don't want to lose in this, but we also want to navigate and get higher returns if we can. But understanding those returns may or may not exceed inflation, but at least we're doing our best to fight against that versus just cornering up and holding your money in cash, right? Because then you're really taking the hit. So we have to keep investing through this, right?
And then with that though, you have to have a blend. So you can invest your money, but what if you come across a really good deal and you don't have that liquid cash? So you might be holding on to it, and it's losing value. But then you buy something at a good number, you more than compensate for your squeeze factor, for lack of another term.
Yeah, you know what? That's a great point. In fact, we're going to talk more on that in the second part of the series when we get into recession. But that is a great point, because if we do nothing more than look back at the last crash in 2008 for a whole different reason. But we had the bubble in real estate, which was really not a real estate bubble per se. It was a real estate financing bubble, right? If you reflect back, everybody, that's were the easy days of lending, right? Pick a payment loan, stated income, no doc. When people were getting crazy loans because the money was just out there and everybody could loan and the laws were over relaxed. And inevitably that inflated prices to a point where the market adjusted, couldn't sustain itself, and it just crashed. Now, I will say this, though, because of that crash, the note business completely changed. It came out of a niche part of the industry to an elevated status of really one of the, if not the pinnacle of real estate, certainly one of the pinnacles of real estate. And it's forever changed the system. We have more inventory and steadier inventory in this industry since that crash than we ever had. Certainly before it. And many people, Dave and I included, made a lot of money and continue to make money from that crash. But to your point, if there's an anticipation that is coming, you may want to sit on some liquid cash, Dave. You're exactly right there.
Yep. And it's just a matter of nobody knows really, Kevin, but a lot of it's intuition, good or bad.
Yeah, it's a feel. Yeah.
It's a total feel.
Yeah.
And you could be right, you could be wrong.
Yeah.
But you and I have that track record, good or bad, of what happened, and then you just pivot accordingly.
Yeah. And you know what? I think for me, at least, one of the lessons I learned in that last crash, I was doing a lot of real estate, and, like 100, what were we doing? 50, 60 properties a year. So pretty high rate on that. And I also owned part of a mortgage company. Now, I really didn't go to the mortgage company. We were doing just regular originations, okay? Just regular mortgages at that particular company. But that business was kind of booming, and I had a guy, looking for an investor. So I put some money into that, but I wasn't, working in the office. I wasn't doing any of that. But I'd go buy enough, just to check in and see what's going, because I did have a financial interest in the company. And with my background in notes and everything else, I had my mortgage broker's license and real estate license and securities and all that stuff back then. And I remember walking through and just looking at the loans that were being processed, just going, what are we doing? But the thing was, if you didn't originate the loan for this person, somebody else sure as heck would, because the government's going to buy the paper. And these loans were just garbage. The borrowers could not afford to pay them. If the interest rate went up, they were done. So people essentially were being set up for failure. But again, as a part of the business, you're like, if we don't do it, somebody else will. And I remember just going, this can't last. And I should have had more time. I should have stopped and felt a little bit more about it and just let me play this out, a little bit more, because obviously that went all tank there. So there's definitely, this is not a science, per se. There's definitely a feel part of it as well, where we can't ignore the math, and you have to. I'm definitely going to be better, obviously prepared, and that's what we're hoping to share in this podcast series.
Right. And as we move into this, Kevin, there were certain techniques that I used that I thought that would preserve, quote unquote, my profit out there. And as the market shifted, it all just evaporated anyway. Mm-hmm. So I'd like that's not appropriate now, but I really want to get into that just so people understand what the challenges could be if you go down, depending upon the rabbit hole, whatever you're chasing, you think it's going to save you.
Mm-hmm. Awesome. Let's start with this then. So a lot of my listeners are going to already own notes. And the thought process being, well, I've got borrowers, and let's just say somebody has 10 notes, just to pick a number. They've got 10 notes, they've got performing notes, people making payments, no problem. Concern with inflation is cost of goods are going up, gas and food and everything that we talked about, and people have to start prioritizing their debt. For the most part, I would think people want to keep the roof over their head. So if they're struggling financially, they want food on the table, roof over their head, but they also need gasoline to get to and fro to continue to make money. So one of the things I look at too, by the way, is credit card debt. And Dave, I'm sure you have charts and graphs and things like that we can look at for credit card debt. And we've seen it elevate. It was really low, and then all of a sudden it started to creep up there. Yeah. Those will be the first not to get paid. So I do look at as an indicator the default rate on credit card debt, and pay attention to that in the news, everybody. We're just starting to get some information on that. So not only has the debt gone up, but now we're starting to see a default rate, and people will prioritize. So can you, if you own 10 notes, are there going to be a percentage? And we don't know what that's going to be, but are 2 of them going to go into a non-performing type of a status, and how are you going to deal with that? So going back to David's point of risk is simply not knowing in some cases, what would you tell somebody, David, if they had 10 notes and they're concerned about this? What should they do today to help them offset that risk?
I put this out not too long ago, Kevin. Service companies may not like this, but whenever I board a note, I make it a point to call the payer and get to know them and say, I'm in ear here if you need me. So they know me. And that's served me well. In this case, I would call your borrowers and just say, how are things going? How's the job thing going? How's inflation hitting you? Are you squeezed? If there's a problem, let me know. Well, let's work it out. And that's one thing that I believe in, but I'm sure there are others that would, like I say, servicing companies that would say, don't go there.
Yeah, well, let me ask you this. Now, of course, David did not say you're calling to collect a debt. Sometimes there's a license for that. You're calling to let them know, you heard what he said. How's it going? And an important thing is communication with people, because when people do run into problems, there is a tendency to curl up and not answer the phone and that sort of thing. And that's the worst a borrower can do, but most of them do it. So we want to keep that communication. So I like that part of it. Let me ask you this. When you do that, do you position yourself as the owner of the note or more of a manager of the company that owns the note?
I don't mind saying I'm the owner. It doesn't bother me a bit. Okay. Now, let me give you an example, Kevin. Of that pool,
because I probably would say I'm a manager, or I would do that a little different myself. But go ahead. Yeah. So you tell them you're the owner.
My goal is to say that I'm there. I could be your friend if you need one. Okay. So on a note that I just purchased in Texas, Turns out the guy was very irregular in his payments. It was from that same seller that we were talking about, Kevin.
Mm-hmm.
And
you knew ahead of time that payments were irregular before you bought it. Yeah. Just to clarify for the audience. Right. Yeah.
So the note seller redid the payment history. Turns out the payer's $8,500 behind. And yeah, so he was not aware of that.
And by the way, everybody, this was a self-serviced note. So this wasn't a servicing company that miscalculated. Right. This was a note creator who received the payments and escrow and everything themselves. And they made a miscalculation here. That happens in this industry. Go ahead, Dave.
Okay. So with that, I called Robert up. I said, here you are. And he had already seen the estoppel agreement and the payer, the affidavits and all that, confirming what the payment history was. Mm-hmm. And that's what was the red flag for him. And I said, what are you going to do? I said, number one, your insurance is up. He says, I'll take care of that. We don't want to move. He must have said that 4 times. We can't move. I thought, good, emotional equity.
Yeah, and plus rent is probably 3 times what they're paying.
Exactly. And he's got 3 or 4 kids. They've been there for 10 years, so it was a long seasoning history. And we're working it out. So he got me his new policy. I talked to him yesterday and today again. We're going to be, we got the Texas hardest hit funds, which is what you had mentioned to your buddy, Kevin. Mm-hmm. He's got an application there to get that taken care of. So it's all good. And on the Texas hardest hit funds, I'm not going to say what I paid for the note, but I'm not going to have much in it after I get the $8,500. It's a good thing. And the guy's in his house. He's happy. His wife is sick. He's happy. He's good.
Yeah. Yeah.
And then we're going to retool the rest of it. Because he's in this position, I'm going to mod the note, add a servicing fee, add a late fee, and I'm going to attempt to get a deed in lieu in case he falls on his face again.
Yeah. So you're providing solutions to them for the problem that they have, obviously. Again, knowledge based on the best thing to do there. And by the way, just for clarification, I know he said hardest hit fund. That's old habits are hard to die. The new rebranded hardest hit funds now is called the Homeowner Financial Assistance Program. And by the way, every state in the United States received part of that $10 billion that was set aside for that. And man, if you're not paying attention to that, you are missing out on something really special, because once that money is spent, it is gone. So I'm here in Florida, for example. Our state got $167 million, which they will spend at about $50,000 per person. That's the maximum. Right. So you can run the math there. That's a lot of deals. How much of that 167 million goes to you depends upon how many people you help stay in your home. So it's really an awesome program. But back to your point there, Dave, the reason I said I would position myself, and there's no right or wrong here, everybody. It's just a different way of doing business. Back when I owned a lot of properties that I had some rentals, I didn't want my tenants to know that I was the owner, because then they start with the harp strings and oh, this is tough. And you're the rich guy that owns the property, because apparently if you own, rental properties in most people's mind, you're just, you've got all the money in the world. And, then it makes it more difficult, to enforce, our child's this and that. So for me, I felt I didn't want to be that close where they want to buddy up and maybe emotionally try to use that against me. And I know some note owners, look, nobody wants to foreclose on anybody. That's not why we get in this business. That's the last thing we want to do. And thankfully, it's such a small percentage of the business. It's really statistically insignificant. But we have to have the ability to do it, because at the end of the day, again, that helps us weigh our risk out there. Are we willing to do that to protect our investments? And again, you got to pay to stay sort of thing. So after a couple of incidents like that, I decided, I'll reposition myself and be true about it, because all of the properties I had were through LLCs and trusts and things like that, where I am a manager of the LLC. So I wasn't lying to people, but I was putting it in a way where I said, well, I'll check and see what ownership thinks. I'm the managing partner of the company, but I always like to have that third party, even though realistically it was me, that could make that decision. So your takeaway from this, everybody, is you do it the way that you see best for you and your personality, what you want to do. Like I said, there's no right or wrong. But between those two options, I think you could come to something comfortable there. But also just to make this point again, some states do require licenses for debt collecting. So in this, you're gathering information. Do you want to stay? What kind of payment do you think you can afford? You never heard David say, hey, if you guys don't catch up right now, I'm going to accelerate this loan and foreclose and have you. That's crossing lines you don't want to cross. Not that anybody, I think, listening would do that, but just want to point that out to people. So open lines of communications really. I think we could clearly state that's one of the steps that you need to take with your borrowers, really as a preemptive move. Agreed?
Agreed.
Yeah, it just makes sense because you don't want them to clam up and deal with uncertainty. If you do have, so let's take it a next step here. And I've had this happen recently. One of my other client students, as I mentor one-on-one with people, as most of my listeners know or should know, I help guide people through this. And this person bought a non-performing note. Now, once again, it's not performing when you buy it. You know what the payment history is. We did full due diligence on this. But the person was showing signs that they want to stay. Because once again, there's equity in the property. They're paying their property taxes, but not their mortgage. The real estate itself was the yard's being cut, the bushes are being trimmed. So they're treating the property that they want to stay. So little clues like that made sense that we can do some kind of a workout here, some kind of resolution with or without the government funds. But at the end of the day, on the number side of things, if we had to take the property back or move it to a foreclosure, we're going to be safe there as well. So good looking deal. A student client purchased it. And this borrower just would not return calls. They would not respond to anything. And once again, worst thing that borrowers can do, but a lot of times that's all they know. Look, if they're not paying their loan, once again, they probably aren't paying credit cards. Yep. They probably aren't paying an auto loan. They're getting phone calls, not just you. They're getting debt collectors all the time. And as far as they're concerned, you're just another debt collector. I'm going to ignore you and delay the problem. So what happened on this, one of the other resolutions, if you're not getting responses, if you have borrowers that are not paying, send a door knocker. There are services like We Go Look that you can pay $75 to. They'll go out there, hand deliver anything that you give them to deliver, try to gather information, try to get a phone number, take pictures of the property, the street, the neighborhood, whatever you instruct them to do for $75. That's a no-brainer. A knock on the door is going to be much more effective than keep sending letters and keep leaving messages. And I know, Dave, I believe you've done that before with door knockers. I think you used a different service, but what's your experience with that?
I have, and I've also used a shock and awe.
Explain that. Yeah.
That is, you send all the loan docs with a demand letter in a FedEx box. How many people get a FedEx box typically?
That's clever.
Yeah. Gordon's.
Yeah. So not a letter, not an envelope, FedEx, a box. Yeah.
I like it. Gets their attention.
I like it. I love it. Yeah.
And basically it says, please call me. You are in default. Here's the loan docs. No questions asked. You are ABCD, you're in default here. Mm-hmm. What are you going to do? Mm-hmm. But when it gets down, and he was not direct on some people, and he said it always hurt him. So the moment he bought an NPM, non-performing loan, he'd send the shock and awe. It sets the stage that you mean business. Don't play around with me. Let's get it done. Mm-hmm. Either they're in or they're out.
Right. Now, this shock and all the letters in the box, they were on the letterhead, so to speak, of the note owner.
Correct.
Okay.
Correct.
Okay.
Yep.
I like that. So door knocker or the shock and all through the package. Another one is, I have this philosophy. You can tell me what you think about it. I don't know if I've told you this before or not. If you're at a position where you may have, you're just not getting any response. And now you're thinking, I might have to go down the foreclosure road. You could hire an attorney to initiate the foreclosure, list pendants or notice of default, pay for that and start that process. Now you can stop it anytime you want to, but sometimes that's a big wake up as well, because the attorney is going to fire off a letter to them showing that the foreclosure has started. That's a big wake up call for people. If they respond in kind and the communication is open, you can put a pause on that foreclosure process. Now, I'm convinced also, and this just happened recently, I advised one of my students to try this first before going through the expense of the initiating a foreclosure in this particular state. I said, sometimes just a letter alone from an attorney saying that if we don't hear from you, then this is the next step, which is foreclosure. So it's a preemptive action of the foreclosure that wakes them up. And Dave, here's my thought process here. I'm convinced, even if you wrote that letter, if you wrote the context of that letter of saying, we really need to hear from you, there are solutions we may be able to help you out with to prevent a foreclosure, but if we don't, we have no choice but to foreclose. So the letter format is something along those lines. If you sent that on your letterhead versus taking that same verbiage and putting it, with the attorney and putting it on their letterhead, I'm convinced the attorney letterhead is going to get a far better response. Your thought?
I totally agree. Yeah. It just depends upon the situation. You play with A, then you escalate to B, and then you take it on to the next step. I mean, whatever gets the results. Yeah. But the key, Kevin, is you've got to be proactive, because this whole series is about how you can take the situation that's there and create wealth or preserve wealth. That's the whole tenor of what we've just been talking about for the last 20 minutes.
Yeah. You don't want to get in a situation that it gets worse. One other thought is, in most places now, the reality is that you can't really initiate a foreclosure for 90, unless it's 90 days late. But you can do all these other measures. You can do the shock and awe. You can send the preemptive letter, from the attorney, or if you did what Dave suggested, maybe opening those communications now before there's a problem where it's easier. I think you're going to be well served in doing that. Man, those are some really, really good tips there, Dave. And I know we're coming up on our time frame here, so let's move to the next thing here, unless you had final thoughts on that.
No, I'm good. And with the recession, there is going to be a lot of people, sellers, to use the term, sucking wind. And you are there to help them, but you're really there to help yourself.
Yeah.
So it's buying at a discount.
Yeah. So on the slide now, it says why recession can be the greatest opportunity to create wealth. And I'm 100% convinced of that, because once again, if you go back to 2008, all the wealth that was created from all of that turmoil happened after the crash, and those that understood what new opportunities had been created. I'm already, Dave, I had a one-on-one session just before we're recording this podcast. And I was talking with this gentleman, and I talked with somebody yesterday. I'm seeing already more and more money coming into the note space. Now, this is so-called, and it's probably not the best way to put it, but dumb money. And I don't mean that the individual's dumb. It's just they're coming into an industry they don't know anything about. And for us, that's good, because they want to place money in these deals. We're the ones who have the knowledge base to provide them with those opportunities. And that can include selling partials to them. That can include selling whole notes to them. It can include partnering with them. It can be a way of raising capital. So when you have money coming in, because they're scared of the stock market, bonds aren't paying anything, there's risk there. People cashing out of crypto, they know that they can't let it sit in the bank, so they're looking for alternative investments. The best alternative investments, where most people have their IRA money that's self-directed in 401k, it's real estate and real estate notes, folks, and that is our wheelhouse. You're going to have a tremendous opportunity with money coming in, and then it comes down to what do we do with that money? And I think that's a great topic for our next one as well. So the money coming in, I think, is one. Also, inventory is going to go up, right, Dave?
Yeah, yeah. And to that point too, Kevin, if you've got junk now, get rid of it.
Mm-hmm. Liquidate. Yeah.
In a big way.
Keep the good stuff. And if you have some stinkers, yeah, maybe get rid of it, cash out, and get ready.
Because if you take a little hit, it doesn't matter. You'll make it up on the upside, on the other side of the on your next purchase. It doesn't matter, because as things change and values go down, you will thank yourself for getting rid of it now versus later.
Absolutely. So this recession, folks, there's opportunities. We'll talk about it more because we could just barely got into this, and I know that you only can handle so much on the listening side. We'll do another recording on this for sure. But opportunities, we got money coming in. We've got inventory that's going to be increasing. Good opportunity, just like people in real estate. Hey, if sell some real estate now to liquidate, because it's peak market, and we all know it's not going to continue to go up. It has in some areas, but we're going to see at least at a minimum a leveling, and we'll talk about that topic as well. Those are all going to be good things for us. Oh, and the seller financing, as bank interest rates start to go up, I think seller finance notes that are originated are going to start to go up too. Haven't done that yet, and there'll be a little gap in there because most seller finance notes are done around 10% interest. But if banks are now charging, what's the latest on that, 6.5?
Yeah, 6
on the mortgage. So if that starts and continues to creep up, remember in the 70s, Carter administration, 19% to get a bank loan.
We were paying 22%.
Really? I thought they peaked at 19.
A loan for our landscaping company, 20%.
So crazy times, but once again, this is going to be a big opportunity, everybody. So make sure you subscribe to the YouTube channel, and that way you'll get notifications. We're going to put these out on a weekly basis. Tune in, give us a good rating, pay attention to these, because we're going to lay out all these opportunities for you. It's going to be another really great time, just like we saw in the last crash, but we have to be smart, and you don't want to go it alone, right? You don't want to go it alone. You need mentors like me. You need people like Dave that has good inventory that's been vetted. You need good groups. You need to surround yourself with the right people in this, because this is going to be a challenging time. But once again, opportunities are absolutely going to be there. Final thoughts, Dave?
I think we've covered it all. It's just a matter of don't panic. Keep your eyes open, just like when you're going down, when you're skiing down the slope. Left, right, you go around the moguls. You go look 3 moguls in front of you, and you'll find.
Got it. Awesome. Thanks everybody for listening. And please go ahead and share it with a friend, any of your investment groups and everything else. No matter what investments they're into, this is going to be relevant because investors are flocking our way. Thanks for listening, everybody. Look forward to putting together another podcast for you real soon.